This year's been a very good year for me. It hasn't been a good year in terms of the equities indexes. What it has been is a year where the narrative that existed in 2019 and 2020 fell apart. And the high-quality investments and high-quality speculations have fallen in price the same way that the low-quality ones have. In 2020, you'll recall my saying this in interviews, found in particular the junior resource stock market to be overhyped. And while I saw some companies that were on the face of it attractive, they were overpriced. So I sold them. And I was wondering if, as a consequence of selling them, that I would miss the subsequent bull market. I became nervous about the fact that the kind of companies that I like, more speculative natural resource stocks, were ironically underrepresented in my portfolio. And this caused me some trauma. The market took care of me. And what I have found is that the good, the bad, and the ugly have all fallen in price. And given that I believe that we are in the early mid-innings of a very long precious metals bull market, and the early stages, too, of a general resource bull market, I have been very happy about what I've seen this year. Patrick, they are not going to normalize. What they are involved in is codifying a set of lies with the intention of making the investing and, more importantly, the voting community believe that these lies are true. Let's examine this. The central tenet of monetary policy worldwide is negative real interest rates and quantitative easing, which is counterfeiting. What they said is that they might work up the courage to counterfeit a little bit less. That's normal, I guess. More importantly, let's look at the normalization around negative real interest rates. Let's strip all the Fed speak out of it. Let's say that you are a young man, which you are, starting out in business, starting out in life. Negative real interest rates means that you forego consumption, you save, and you send me the money so that I can consume now. And you pay me to consume now while you save and take on the credit risk. Does that make any sense? Is there anything normal about negative real interest rates? When they say they're going to normalize, what normalize would mean to me would be that they would let the market take control of interest rates. So let's do a little arithmetic around that, just for fun. The U.S. 10-year Treasury is the world's benchmark security. It's the one that all other securities are priced against. It's been that way for 60 years. The yield on the U.S. 10-year Treasury is about 150 basis points, 1.5%. So you give the U.S. government money, and they give you 1.5% a year for 10 years. And they're going to do it because they can print. But let's look at this from your point of view as a saver. You give them $100,000 at 1.5%. So they give you back $1,500 a year in a currency that they acknowledge is depreciating at somewhere between 6.5% and 8.5% a year. In other words, the U.S. government almost guarantees you that you are going to lose 5% a year in purchasing power for 10 years. Jim Grant describes this as return-free risk. Franz Pick described this type of investment as a certificate of guaranteed confiscation. So, from the Fed's point of view, normalize means that savers are going to subsidize spenders and take credit risk for guaranteed negative real rates of return. Their idea of normal is that you will punish savers and subsidize spenders. The people they represent, of course, government being the greatest spenders and the worst savers of all. That is normal from their point of view. I think if you put it in those terms, that both you and your listeners will agree that their normal is our bizarre. I think what your listeners need to understand is that we are in the early stages of a natural resource bull market. That's inevitable. It could be postponed by a global recession or global depression, something that cut into demand. But the fact is that supplies are going to become increasingly constrained. In a normalized environment, that means the prices are going to go up. And in precious metals, while the precious metals may suffer, I'm not saying they will, but while they may suffer next year, from an increase in nominal interest rates, an increase in precious metals prices is, from my point of view, almost inevitable. Precious metals prices rise when people are concerned about the maintenance of purchasing power in their fiat and conventional savings products. Let's look at that. Quantitative easing. 40% of the US dollars in existence have come into existence in the last 2 years. Is that because the US economy has grown 40% in size? Of course not. Quantitative easing is counterfeiting. That's what it is. And counterfeiting should make you concerned about the currency. Debt and deficits. Precious metals investors need to think about debt and deficits. In the U.S., the on- and off-balance sheet liabilities net present value of the U.S. government exceeds $150 trillion. And we pay this debt with a budget that's in deficit $4 trillion a year. I'll leave that one alone. But the most pernicious, or from the point of view of precious metals investors, the most promising, oddly, is negative real interest rates. The idea that savers should pay spenders to consume now while savers defer enjoyment and take credit risk is truly insane. And the consequence of that, I think, is higher precious metals prices. Another piece of arithmetic, Patrick, you're going to be sorry you asked me this question. Another piece of arithmetic is that the market share of precious metals and precious metals related investments, despite their attributes, is at an all-time low, which is to say fear is at an all-time low. It is estimated that the market share of precious metals and precious metals related securities in the United States is 0.5% of the value of total savings and investment assets in the country. The 3-decade mean exceeds 1.5%. If quantitative easing, debt and deficits, and negative real interest rates increase the appreciation for precious metals, all they have to do is revert to mean. And if they revert to mean, demand for this asset class will triple. I actually think it will overcorrect. In other words, I think it'll overshoot mean, because that's the way mean reversion works. And if you think about the impact that would have on the prices of precious metals and precious metals related securities, you get some sense of what I expect will happen, perhaps not in 2022, but certainly will happen over the next 5 years. If you look at a history of precious metals bull markets, Patrick, the 2000 to 2011 bull market, the 1970 to 1971 bull market, what you see is that they're not 2 or 3 year long affairs. They're 10-year long affairs. We're perhaps 3.5 years into it. And the dimension is unbelievable. The 2000 bull market, the gold price went from $253 an ounce to $1,900. The silver price went from $5 to $50. I'm not saying that past is prologue. I'm not saying that the precious metals prices will necessarily increase sixfold. But I think they'll increase by more, at least in nominal terms, than other people believe they will. Because I think the arithmetic supports it, even though the narrative is hostile to it.